Here's a picture of U.S. real GDP and its long-run trend, and it's been rising. This is a logarithmic scale, so the vertical axis doesn't really mean anything. It's hard to interpret what it means. And the trend that's been fitted through the data here is a kind of subtle, has some curves in it, so it fits a little better than a straight line would. But what I want to point out is the fluctuations around the trend are pretty small on a sort of large scale. If we're looking from, what's the earliest date here, 1860 to 2000. The big dip in the middle, of course, is the Great Depression. And this gives you an idea of how big the Great Depression is compared to other recessions, other variations in output. Our current recession, or it was a 2-year recession officially, we're officially now in a recovery because real GDP has been growing slowly, went into reverse last quarter, but next slide. Here's a sort of closer look at where we are now. And this introduces another distinction, which is between actual GDP, that's what we have, and something called potential GDP, which is an extrapolation, basically, from the trend we were on. And in the recession of 2007 to 2009, that's the shaded area, so you can see it corresponds to when real GDP is dropping. Real GDP has started growing again, but it hasn't caught back up to the trend, which is unusual. If you the previous diagram, you saw it typically catches back up to the trend pretty quickly. Here, we're kind of running parallel to the trend. There might be a little convergence, but the reason it looks like there's a little convergence, if you look closely, is because they've revised the estimates of potential. The potential, as I said, is mostly an extrapolation, but it also, this is projected by the Congressional Budget Office. It also takes into account the size of the labor force, and the labor force has been shrinking in this recovery. Right? People are leaving the labor force, so that reduces potential GDP according to the model they use to estimate it. So at some point in the future, we'll look back and say, well, actually, potential GDP fell more than we realized at the time. At least that's my prediction. I mean, this is quite unusual to take this long to get back to the trend line. All right, so this has been a very slow recovery as measured by GDP and as measured by unemployment than other post-Great Depression recoveries. Next slide. So here's a picture of the growth rate of GDP. This is what people often focus on, and that was the number we just saw from the BEA. That was the rate of change of GDP. It changed -1% from the previous quarter. This gives you an idea of the range. So this is, if you see at the bottom, no, sorry, on the vertical axis, percent change from a year ago. So for each quarterly measurement of GDP, how different is it from not the previous quarter, but the 4 quarters ago? All right, so that smooths it a bit compared to quarter by quarter. And you can see the swings going from -2.5%, so that's a really severe recession, to 7.5% growth. That's a really brisk recovery. At the end, we get to the present era. We had a very deep recession. We had, you know, -4% nearly fall in GDP from one year to the next. You can see that's much more severe than anything else since 1960. That's why it's the sense in which it's correct to call it the worst recession since the Great Depression. And growth bounces back up into the positive range, but look, it doesn't get above 3%, which is quite low for a recovery. 3% used to be the average. If it's the maximum that you get in a recovery, then your average is going to be a lot lower than that. And sure enough. But we're not seeing the 7.5% bounce that you see after the other shaded areas. Those are the recessions, or at least above 5%. So, okay. If the recession is not as deep, then it's okay that the recovery is not as sharp, and that's what we had in the 80s and 90s. That was the great moderation, they called it. But here we've got a very deep recession and a very moderate recovery. That's why we're not catching up to the trend. I said earlier that if you could boost real GDP growth by 0.5% a year, that would be great for the next generation, much more important than flattening business cycles. Well, it's come down. It's come down a lot more than 0.5 percentage point. 10 years is a sort of good length of time to smooth out business cycles because they typically don't last that long, less than half that long. In 2005, the 10-year moving average, so that was from 1995 to 2005. So that's what a moving average is. You average over the 10 years, and then you move the sample forward when you get to the next year. We're now down to 1.6% for the last 10 years. Yeah, not very good. Sure, that includes the recession of 2007 to 9. But if you had a brisk recovery, then you'd recover that, and we haven't recovered that.